This is Jesse Sloan, Executive Director of the American Association for Long-Term Care Insurance and Director of the National Advisory Center for Short-Term Care Information. This presentation focuses on an option that's worth considering if you, a spouse, or a family member have been declined for long-term care insurance. I want to preface the presentation by explaining that our organizations do not sell insurance. We're not paid by any particular insurance company, neither do we endorse any particular insurance company. We encourage you to speak to your long-term care insurance professional, the person who sent you the link to watch this video, or if you have questions and you don't have an insurance professional you're working with, call us and we'll gladly hook you up with one. Every 2 years, the American Association for Long-Term Care Insurance conducts a survey of leading insurance companies and asks, based on those who have applied for traditional long-term care insurance at different age bands, what percentage of applicants were declined by the insurance company? And as you can see, after age 60, it ranges from 1 in 4 to as high as almost 1 in 2 people who take the time to complete an application, they are declined. They have existing health reasons. They may take a certain combination of medicines that control their health, but that the insurance company looks at and says, this is just too high a risk. That's obviously unfortunate news for the people who have applied. But again, as I said at the beginning, today you have an option that's worth considering. What I'm referring to is what's called a short-term care insurance plan of protection. I like to call it long-term care light, as you'll see in a minute. In this particular case, this plan comes from an A-rated insurance company, Medico. It is not available in all states, but it is in about 30 different states. And again, our organization doesn't endorse, we're not paid by any particular insurance company, but because it's a viable option, our goal is to help share this information with consumers and also with insurance professionals. So, a short-term care product provides up to 1 year of benefits. And what consumers should know is that 49% of all traditional long-term care insurance claims that are being paid benefits, those claims last 1 year or less. So while 1 year of benefits seems short compared to what you might read in some of the media, for many, many people, it's certainly adequate protection. What makes a short-term care insurance product attractive to someone who has been declined is that these policies, in this particular case, this one, will accept you if you've been declined previously for traditional long-term care insurance. It uses simplified health underwriting, and we'll show you exactly what that means. It has the same pricing for single women as it does for single men. That's very important because traditional long-term care insurance today charges single women anywhere from 20 to 40% more than men. It can be issued up to age 79, and one of the features that I'll talk about in a second that I think is very attractive, especially for people who have existing health conditions, is a 0-day deductible or a 0-day elimination period. This slide is taken directly off the company's application. As you can see, there are a series of questions, and we've copied this slide at the end of the presentation, so you don't have to pause here now. You can wait to the last slide and then pause it and then read the various questions to see if you could health qualify. So long as you can answer no to the health questions, you are 90 to 95% on the way to being approved for this policy. While there's no question that a long-term care policy that might provide 2 or 3 years of coverage is certainly going to be more protection than a policy that provides 1 year or 360 days of coverage, there are certain features about short-term care coverage that I think make these very advantageous for consumers, especially those with health conditions. These policies do not require the 90-day certification that's required by a traditional long-term care insurance policy. Those policies require that you're going to need care for 90 days in order to even think if you can qualify for benefits. Those policies, the traditional ones, typically are sold with a 90-day deductible. 94% of all traditional long-term care insurance policies today are sold with a 90-day deductible, which means you have 3 months before you're ever going to be eligible for benefits. A short-term care policy does not have the 90-day certification, and as you'll see when we talk about pricing and options, these policies have a 0-day deductible option. That means if you require care, you could start receiving benefits right away. That's certainly an advantage, especially for people with health conditions. Another reason why some coverage is better than no coverage is that with these policies, they will accept applicants up to age 80, and in some cases beyond, but this particular policy will accept applicants up to age 79. They will also, as I said previously, accept applicants who have been declined for traditional long-term care insurance policies. Not all short-term care policies will do that, and clearly they will accept those who have existing health conditions. These policies look and feel in many ways like traditional long-term care insurance. They cover many of the same services: nursing home, assisted living, home health care. The eligibility for benefits is going to be similar, requiring you to meet the inability to perform activities of daily living. What are some of the key advantages, I think, of these policies are, as I said, the deductible. That 0-day deductible, or the shorter term access to benefits, the quicker access to benefits, is especially attractive to people who have health conditions, and clearly if you've been declined coverage, you have health conditions. The policies do give you some flexibility, meaning that if you're willing to take on some of the financial risk, then you can pick your option in terms of what are the maximum benefits, up to 360 days. So again, my goal on this slide is just to give you a flavor of what this policy would conceivably cost you. So if you were purchasing coverage that had a $100 daily benefit for 360 days, which means your maximum benefit would be $36,000. And in this particular case, I cite the cost for a single woman, but I remind you that costs are the same for women as they are for men. So at age 65, with a 0-day deductible, which means you are eligible for benefits right at the get-go, you're talking about $814 a year. At age 75, if you took a policy with a 30-day deductible, you're talking about just under $1,500, so it's just a little bit over $100 a month. But again, while these are actual rates taken off the rate sheet at the time, rates can vary by state. I urge you to request a copy of the brochure and speak to an agent to get rates that are specific for your age and your state. So if you or a family member have been declined for long-term care insurance, know that today you do have several viable options that are worth looking at. And I urge you to talk to the insurance agent who shared this video with you, or, again, if you are not working with a knowledgeable specialist, please feel free to call the National Advisory Center at area code 818-597-3205, 818-597-3205. Thanks for watching, and I'm going to conclude with the questionnaire about health questions. Please feel free to hit pause, read it, and see if you can be accepted before calling for more information. Thanks again for watching. Please feel free to hit pause now.